Before you try to make money in trading, you need to understand the basics. Without them, trading turns into guessing, and guessing in the market usually ends the same way. You lose your deposit. So first, what is Forex? Forex stands for foreign exchange. It is the global market where people buy and sell different currencies. Every country has its own currency, like the US dollar, the euro, or the Japanese yen. How currency exchange works. Currency exchange is simply the process of changing one currency into another. This usually happens when people travel, buy products from other countries, or do international business. For example, imagine someone from the UK traveling to the United States. In the UK, they use British pounds, but in the US, people pay with US dollars. Before they can spend money there, they need to exchange their pounds for dollars. This can happen at a bank, an airport exchange booth, or through their bank card when they pay. Forex trading works in a similar way, but traders are not exchanging money because they need another currency. Instead, they are trying to make a profit from price changes. When traders believe one currency will become stronger, they buy it. If they think it will become weaker, they sell it. The idea is simple: buy at a lower price and sell at a higher price, or sell first and buy back later at a lower price. Size and features of the Forex market. The Forex market is the largest financial market in the world. Every day, trillions of dollars are exchanged between banks, companies, governments, and traders. This makes Forex much bigger than stock markets. One important feature of Forex is liquidity. Because so many people are trading, it is usually easy to buy or sell currencies at any time. Another key feature is that the market is open 24 hours a day, 5 days a week. Trading starts on Monday and continues until Friday. Different financial centers around the world open and close during the day, so the market keeps moving almost all the time. This gives traders many chances to find trading opportunities. Basic Forex trading terms. Before you start trading, it is important to understand some basic terms that traders use every day. When traders say bullish, they mean they expect the price to go up. If someone is bullish on a currency pair, they believe its value will rise. The opposite word is bearish, which means the trader thinks the price will go down. You will also hear the words long and short. Going long means buying a currency pair because you expect the price to increase. Going short means selling because you believe the price will fall. Two very important tools in trading are stop loss and take profit. A stop loss is a price level where your trade will close automatically if the market moves against you. It helps limit how much money you can lose. A take profit is the opposite. It closes your trade automatically when the market reaches your target profit. What are currency pairs? In Forex trading, currencies are always traded in pairs. This means you are comparing the value of one currency against another. Instead of buying a single currency, you are always buying one and selling another at the same time. A currency pair shows how much one currency is worth compared to another. For example, in the pair euro/US dollar, the euro is compared to the US dollar. The price tells you how many dollars are needed to buy 1 euro. When the price of a currency pair changes, it means the value between those two currencies is changing. One currency may be getting stronger while the other becomes weaker. This is the basic idea behind Forex trading. Traders watch how currency pairs move and try to profit from those changes. If they think the first currency in the pair will gain value, they buy the pair. If they think it will lose value, they sell it. Base currency and quote currency. Every currency pair has two parts, the base currency and the quote currency. The base currency is always the first currency in the pair. The quote currency is the second one. The price of the pair shows how much of the quote currency is needed to buy 1 unit of the base currency. For example, look at the pair EUR/USD equals 1.10. Here, the euro is the base currency and the US dollar is the quote currency. This price means that 1 euro is worth 1.10 US dollars. When the price goes up, it usually means the base currency is getting stronger compared to the quote currency. When the price goes down, the base currency is getting weaker. So when traders buy a pair, they are buying the base currency and selling the quote currency at the same time. How buying and selling currency pairs works. In Forex trading, every trade involves two actions at the same time. When you open a trade, you are buying one currency and selling another. This is because currencies are always traded in pairs. Let's take a simple example with the pair EUR/USD. If you believe the euro will become stronger compared to the US dollar, you would buy the pair. This means you are buying euros and selling dollars. If the price goes up after you buy, you can close the trade and make a profit from the price difference. On the other hand, if you believe the euro will become weaker compared to the dollar, you would sell the pair. In this case, you are selling euros and buying dollars. If the price goes down after you sell, you can close the trade and keep the profit. What makes Forex trading interesting is that you can make money in both directions. The market does not have to go up for you to profit. Traders just need to correctly guess whether the price will rise or fall. Because of this, traders spend a lot of time studying charts, market news, and price movements. Their goal is to find good moments to enter the market and take advantage of price changes. Pips and pipettes. In Forex trading, price changes are usually measured in pips. A pip shows how much the price of a currency pair has moved. For most currency pairs, 1 pip is the fourth number after the decimal point. For example, if EUR/USD moves from 1.1000 to 1.1001, the price has moved 1 pip. If it moves from 1.1000 to 1.1010, that is a movement of 10 pips. Pips help traders measure both profit and loss. When a trader says they made 20 pips, it means the price moved 20 pips in their favor. There is also something called a pipette, which is 1/10 of a pip. It is the fifth number after the decimal point. Pipettes allow brokers to show more precise price movements in the market. Lot size in Forex trading. In Forex trading, a lot shows the size of your trade. It tells you how much of a currency you are buying or selling in the market. Understanding lot sizes is important because it affects how much money you can gain or lose from price movements. There are 3 common types of lot sizes. The first is the standard lot. A standard lot equals 100,000 units of a currency. When trading one standard lot, each pip movement is usually worth about $10. The second type is the mini lot. A mini lot equals 10,000 units of a currency. In this case, each pip movement is worth around $1. The third type is the micro lot, which is the smallest size most brokers offer. A micro lot equals 1,000 units of a currency. With this size, each pip movement is worth about 10 cents. Many beginners start with micro or mini lots because the risk is much smaller. It allows traders to practice and learn how the market moves without risking large amounts of money. As traders gain more experience and confidence, they may choose larger lot sizes. Subscribe for the next trading guide and share your thoughts in the comments.